Let's face it, paying tax on your investment gains feels like being penalized for doing the right thing. It's like showing up to the gym, doing 100 push-ups, and being fined for sweating too much. You finally start building wealth, and the government's like, nice portfolio, we'll take 20%. But what if you could legally tell them to back off? With a polite smile and a tax shelter, of course. That's what tax-free investing is all about. And if you're in the UK, you've got some serious tools in your corner. From ISAs to pensions to sneaky little loopholes your accountant probably won't advertise on his website, here are 15 ways I invest in the UK without handing over a chunk of my gains. Let's count them down, and yes, every one of them is deliciously legal. 15. Use ISA allowance every single year. Let's start with the GOAT. The ISA is the UK's most powerful tax-free investing tool. You can put in up to £20,000 a year, and any growth, capital gains or dividends is completely tax-free. No tax now, no tax later, no tax ever. And that allowance resets every April 6th, so if you don't use it, it's gone forever, like your gym motivation in February. Don't let it go to waste. The cash ISAs are basically savings accounts wearing a fancy hat. If you really want growth, go for a stocks and shares ISA. You can invest in index funds, ETFs, dividend stocks, and all your gains are still tax-free. Just remember, it's for long-term investing, not next month's rent. Time in the market, not timing the market. 14. Buy gold sovereigns and gold Britannias from Royal Mint. Buying gold from the Royal Mint is a tax-free loophole few investors use. Here's a smart move that slips under most people's radar. Why? 2 reasons. 1. No capital gains tax. Certain gold coins minted by the Royal Mint, like gold sovereigns and gold Britannias, are classed as legal tender in the UK. Because they're legal currency, any profits you make when selling them are 100% exempt from CGT. That means if gold doubles in value and you cash in, HMRC doesn't touch a thing. Try pulling that off with property or stocks. 2. No VAT on investment-grade gold. Under UK law, investment-grade gold bullion is 0 rated for VAT, so you don't pay VAT when buying it, provided it meets purity standards, and coins like the Britannia and Sovereign qualify. 13. Opened a lifetime ISA. You can if you're under 40. Think of the lifetime ISA like the government giving you a high five for being responsible. You can put in up to £4,000 per year, and the government adds a 25% bonus. That's £1,000 of free money annually. It's for first-time home buying or retirement, so it's not flexible, but the tax perks are massive. And yes, the bonus is also tax-free. This one's a cheat code. 12. Use a junior ISA for my kids. Want your kid to start adult life with a financial head start? Open a junior ISA, where you can invest up to £9,000 per year tax-free on their behalf. All gains are theirs and not taxed when they access it at 18. Think of it as giving them compound interest instead of just birthday cards. Plus, it teaches financial literacy without the lectures. 11. Use a SIP, self-invested personal pension. If you love control and hate tax, a SIP might be your best friend. It's a personal pension where you choose what to invest in and get tax relief on contributions. That means the government adds money to your investments. Yes, really, you don't pay tax going in, and your investments grow tax-free until withdrawal. It's like planting a money tree and watching it grow tax-sheltered. 10. Maximize employer pension contributions. If your employer offers a pension match and you're not taking full advantage, that's like declining free cash. Your workplace pension is tax-free on the way in and grows tax-free inside the pot. It's also one of the few times where free money actually exists without strings. Max it out, always. 9. Take advantage of the capital gains tax allowance. Capital gains tax kicks in only after your profits cross the annual threshold, which is £3,000 as of 2025. Stay under it and you don't pay a penny. So, if you're smart with how you sell, you can keep gains within that allowance and pay 0 tax. That's not a loophole, that's strategy. 8. Use your dividend allowance wisely. As of 2025, your first £500 of dividend income is tax-free. It used to be £2,000, but the Chancellor decided to get stingy. Still, every pound counts, and if you combine this with an ISA, you can shield even more. Use it or lose it. 7. Invest in VCTs for 30% tax relief. Venture capital trusts are high risk, but the tax perks are juicy, so put in very little here. You get 30% income tax relief upfront, tax-free dividends, and no capital gains tax. They're not for everyone. You're investing in early-stage companies, but the tax savings can be enormous. Just don't bet the house on them. If this is helpful so far, hit subscribe. We break down trending money topics like this every week. We provide systems, not noise. Growth, not hype. 6. Use EIS, Enterprise Investment Scheme, for startups. If you've got an appetite for risk and want to help fund UK startups, EIS is like a gourmet tax shelter. You get 30% income tax relief, capital gains deferral, and if the company succeeds, no capital gains tax at all. Plus, if it fails, you get loss relief. It's tax-advantaged capitalism at its finest. 5. Gift assets to a spouse for double allowances. Married? You've got a tax hack built in, and my spouse loved this. You can gift assets to your spouse without triggering tax, letting you double your CGT and dividend allowances. That means more gains, zero tax, and less grumbling when you say, "Babe, I moved the shares into your name." It's teamwork, but also tax planning. 4. Use BED and ISA or BED and SIP strategies. These sound like awkward IKEA products, but they're actually smart moves. Sell assets outside your ISA or SIP. Then rebuy them inside the wrapper to shelter future gains. Yes, you'll use your CGT allowance, but from then on, it's tax-free growth. It's how the rich stay rich and sleep well. 3. Invest through your limited company, if applicable. Got a side hustle or full-blown business? A limited company can be a tax-efficient wrapper. You can invest retained profits, sometimes pay lower corporation tax, and structure dividends strategically. Just be careful. There are rules, reporting headaches, and HMRC is always watching. But if done right, it's a power move. 2. Use tax-free bonds for fixed income. Some government-backed bonds, like NS&I premium bonds, offer tax-free winnings instead of interest. It's not technically interest income, so no income tax applies. You won't get guaranteed returns, but the chance of a win is something. Plus, your capital's protected by the government. Not bad in shaky markets. 1. Keep as much as you can inside tax wrappers. The ultimate rule: stay inside the tax shelters. ISAs, pensions, LISAs, GISAs, EIS, all of them exist to help you legally grow wealth without linking money to HMRC. The more of your portfolio that lives inside these wrappers, the less you lose to tax, and the faster you build wealth. So don't just invest smart, invest sheltered. Question of the day: which of these tax-free strategies are you already using, and which one surprised you the most? Drop a comment below. Let's see how many people are sleeping on the best ones. That's it for today's countdown. If this helped you rethink how you're investing in the UK, hit that like button, subscribe, and share this with someone who thinks tax-free means dodging HMRC. This is the Smart Money Countdown, and we'll see you in the next one.